I think this is particularly challenging, again, for metals and mining because the path to decarbonization is so different depending on what subsector you're active in.
There is this movement to make ESG disclosure mandatory alongside financial disclosure, and I think that would be the holy grail for an investor who just needs to read one report and can actually see the data.
I think there is also evidence beginning to materialise that the net present value argument is no longer the only metric on which investors are prepared to make decisions.
ESG has become the critical piece for the mining industry of late. As a subject, it's certainly had its fair share of coverage and discussion. And we're going to be taking a fresh approach today in this session and honing in on how can ESG transform valuations. So I'm very pleased to involve a panel of experts who place ESG issues at the forefront of their work every day. So introducing in turn, I have Kate Southwell, General Counsel at Parlour Investments, Jamie Strauss, CEO of Digbee, and Daniel Liu, Climate Risk Analyst at Bloomberg New Energy Finance. Thank you all very much for joining me for this discussion. So getting us started, I wanted to focus in on the fact that despite some of the excellent cash flows that we're seeing across the various tiers, particularly in the producers for mining, what is preventing higher valuations versus other sectors? Jamie, I know you've got a lot of views on this topic, so perhaps you could start us off with this one.
Yeah, well, it's really a whole host of things. And I mean, I guess the easiest thing, and I'm sure Bloomberg have got some stats on this as well, but if you look at the Standard & Poor's ratings, mining is the worst perceived sector on the planet, perhaps alongside oil and gas or energy. But we've just got to accept, where the sector is as a result of that. So, I mean, we first of all have for decades been working in a tiny pool of capital compared to where capital is generally in the world and the other industries it goes to. We're missing out on many of the growing pools of capital, which to a large extent are coming out of those already small pools of capital and largely are green related. There's a lack of credibility, I think, in this sector has gone on for some time. The cyclicality element is not acceptable to all types of investors. We must also accept we carry a very large carbon footprint on our shoulders. And despite the efforts in recent years to try and start reducing that, no doubt encouraged further by the events in the next 2 weeks. But ESG is a form of communication. I think we just got to accept that there's a complete lack of standardization, which just does not help the journey for the mining sector. And without having standardization, there's no meaningful comparison, and investors relate almost everything to each other. So if you don't have comparison, it's very difficult, therefore, to be able to bring the mining sector in line. So with no means to credibly track ESG, I suppose it's not surprising. But let's flip that around a second and say, look at the opportunity to turn that around and potentially to create one of the great revaluation stories of a generation. ESG is a blessing in disguise. It's a communication thing. As much as it's a means to activate change on the ground, it is a communication. Sustainability is the big thing, and ESG is almost a transition to effectively to get us to get that. So accepting some well-known tragedies over the last few years, actually the sector's had quite a strong 20-year period of improvement in health and safety, water, nature management, and others. There's a new generation of mining companies that are wanting to deliver the new products, the products that are going to save the world, but in a more sustainable way. And I think there is also evidence beginning to materialize that the net present value argument is no longer the only metric on which investors are prepared to make decisions. So I'm sure I and the other panelists could go on for hours on this subject, but I really believe in the latter part of what I'm saying here. I think this is an opportunity not to be missed. And I think it's not going to take an awful lot for the dial to change if you can start to access some of those other pools of capital for what is only a $1 trillion industry or something to begin to really start to change your valuations.
Yeah, certainly. Excellent. Touched on a host of challenges there. Kate, would you agree this is a communications piece primarily, and actually the industry's acting on quite a lot of good change in the right direction, but ESG itself is really a communication piece for all involved?
Well, it's a tricky question to unpick. I would agree that the industry is definitely moving in the right direction, and there's been a tremendous amount of momentum, largely driven by, I think, the pools of capital that are available, but also by a genuine willingness and wish to improve things like safeties and tailings and responsibility in communities, etc. So I do think there's been a huge amount of improvement in the last decade in particular. Whether or not I think ESG is just a communication matter, I mean, I think it goes more fundamental to that. It's about a sustainable business model, and the ESG data is, kind of a separate issue in some ways, and that's something that's helping people understand the journey that these companies are going on, and as you say, compare apples to apples, or understand the specific risks that a company may be exposed to. But I think it goes right down to strategy. I mean, the mining companies, I think, have done certain things well in the past. They've understood that they need a social license to operate as well as a mining license. They've done some things quite badly, and things like diversity, in itself show that we've got a long way to go in terms of improving the industry's, optics as much as anything else, as much as the fundamentals. But, as much as people focus on mine life, I think now people are focusing on transition risks and the impact of carbon pricing. And in an energy intensive world, frankly, it's an existential question for the mining industry. And if they don't address it upfront, then there is no future. And there's no point if you've got a 30-year mine life if you haven't, got your heads around sustainability and ESG. So I think it goes deeper than a purely sort of marketing or data issue.
And Adam, sorry to interrupt before Daniel comes in. I didn't mean to say that ESG is just a communication tool. I'm saying is, as part of the ESG structure, it is a fantastic tool from a communication point of view if you do all of the bits before and you bring ESG into the heart of strategy, etc., as Kate was saying. Yeah, indeed.
Yeah, and let's unpick some of those details on that you did raise later in the conversation. And Danielle, I'd like to turn to you now and just get your view from BloombergNEF just around, what's preventing these higher valuations in mining? Is it a lot more nuanced as everyone else suggests?
My perspective is that it's just that the industry is facing so much uncertainty, and we've touched on elements of this already, but we know that climate action is going to impact every single industry, but mining and metals is under a particular type of stress and pressure because they not only need to fundamentally transform their processes, but they need to do that and at the same time continue and ramp up output and production, which is a very hard thing to do. And so the element that I'm really focused on when it comes to analyzing company valuations or company future strategy is how will companies be impacted by this transition risk? So as the world transitions to net zero and low carbon and Paris alignment, all of these market conditions that come with that, it's going to reshuffle everything, the competitive standing of many, many industries, market share, who has the better business model and who, maybe gets left behind. And I think that that is creating so much uncertainty that it's making it almost impossible to really say, hey, you deserve a better valuation, because we just don't know what the next several decades of climate action is going to bring.
Certainly. So thinking of, let's focus in on environment then. We've got COP26, as you alluded, Jamie, coming up in a couple of weeks after this recording. And everyone's going to be focusing on improving environmental commitments. What is, what is the paramount transition risk then at the moment? It seems it's quite hard to quantify that at the moment. And what does a meaningful zero carbon commitment look like from a company? Is it sort of picking off a distant date and saying we'll be zero carbon by then? What sort of things do you look for as ESG experts and investors? Daniel, perhaps we'll start again with you.
Sorry, for me?
Sorry, I was going to say Daniel, but Jamie,
Okay.
if you want to take it.
No, ladies first. I'm excited to hear what Daniel's going to say.
All right. Yeah, I mean, I think transition risk, like I said, particularly impacts the mining and metals industry, I think along these two elements. So one for us is carbon risk. So we know that this is a high emitting industry, and there's a very big chance that many markets are going to start introducing mandatory carbon prices or carbon taxes, things like that. So that's going to hit this industry really hard and really upend cost of doing business. The other is demand risk. So we touched on this already, but the low carbon economy is going to demand fundamentally different materials than a fossil fuel based one. So who's providing those new materials of the future? Who's getting left behind if they're holding on to business models around, these old materials that we're moving away from? On the second point, there's a lot of really great research around what makes a good net zero commitment. And from BNEF's perspective, it's a couple of things that you kind of have to hit. You have to be very clear on timeline. So setting your target as 2050 or earlier really is where you want to be. You want to set a number of interim targets too. I think that's a really strong, that makes a net zero target really much stronger and much more believable. If you're saying, we're going to get to zero by 2050, but by 2030, here's what we're going to do. By 2025, here's what we're going to do. So interim targets are important. Being very clear on what scopes are included, very, very important. And this is an area where standardization really needs to come more into play. We really like to see scope 3 commitments, but for the majority of industrial sectors, that's not what's happening right now. Net zero targets, when they come out, are most usually only scopes 1 and 2. So yeah, need for more standardization on all this, but there are a couple of things that we can point to for a model of a good net zero target.
Excellent. Yep. Jamie.
I think, with regards to the transition risk, I think what we'll see over the next 2 weeks, particularly at COP26, is, all of these development companies or developing countries, they need to get a fair balance in this whole COP26 negotiation. And there is significant risk in a lot of these countries, which I'm sure others are probably better qualified than I am to talk about, in terms of, if we are going to move and we're going to shift all of this business risk and we're going to start to change this thing, we need to be able to manage that transition, manage that process to avoid non-financial risk happening in some of these countries, whether it's civil unrest, political unrest, food shortages, water scarcity, et cetera, et cetera. So as those countries are trying to rebalance, they also, as we tend to find with higher commodity prices, have an increased tendency to raise taxes on mining companies as well. And maybe that is the fair balance to be able to do this so that they can effectively start to integrate within that process of kind of changing the narrative and effectively trying to move things forward. So if you do have a higher emitter, as Dana was saying, then effectively they are going to become a higher taxpayer within that country. And so I think there are checks and balances that can effectively begin to take place within this transition, which can encourage change, while at the same time also hopefully help those countries address their own underlying issues and risks as a result of this transition. I think Dan has largely said what I was going to say with regards to the net zero situation. I would just add one thing specific maybe to the mining sector is, not all processes can happen without carbon related fuels. I'm on the board of a lithium company, for instance. You can't get to 900 degrees centigrade to calcinate the material unless you use gas or other forms of carbon fuel. So there does need to be an acceptance that to produce the commodities and products of the future, we are still going to have to do this. And then you've kind of got this greater unwinding problem of, how do you do carbon offsetting? Is that just, kind of playing with the books and things? And that's a much bigger subject. So it's difficult to do this, but we've got to accept the fact that it's not a straightforward linear line to just moving away from carbon. We do need to have other means to be able to address this.
Yeah, it's paradoxical with mining. We need so many metals to green the planet, yet to get them, we need to adopt potentially ungreen practices. Kate, could I turn to you and get the buy-side view on some of this transition risk, how you sort of look at that across your portfolio, because you have obviously existing companies and then new investments that you're looking to make as well.
Yeah, I mean, firmly agree with both panelists. I mean, this is a huge issue, and it's certainly not a straightforward or simple or linear kind of, do X and Y comes out problem, which is one of the reasons I think there are so many debates, interesting debates about how to get where we want to be. We have different sides of the business, and obviously our private equity portfolio will be looking at a different kind of timeline and horizon, and that's the one where I think carbon risk in particular comes in. You have to be factoring in a carbon price of, I don't know, $100 a ton or something is what most people are working towards, and that does mean that quite a lot of businesses that we see may be very profitable now but have no long-term future. On the sort of liquid and physical side, it's a bit different, and there's still a little bit more flexibility and demand in those materials. So I think, you have to adopt that portfolio approach, but certainly what we like to think of as sort of future-proofing a portfolio means a balanced and diversified portfolio, and one that does take into account these transition risks. There's some things, in particular things like battery chemistry, that nobody's very good at predicting. But I think, irrespective of what exact battery chemistry we end up with, for the next 10 years at least, we are looking at significant demand, as we've spoken about, for copper, nickel, cobalt, lithium, and rare earths. So that's sort of uncontroversial. But I do think that the specific battery chemistry is still up in the air. And one of the things that we like looking at as businesses that, again, are addressing these kind of technological risks as well, and coming up with innovative solutions to these problems.
Yeah, and just on the scope 1, 2, and 3 standards, have you sort of set a bar at the moment, or are you seeing companies sort of addressing 1 and 2, but maybe not looking at 3 yet, or they're getting prepared? How do you view it through your firm?
I mean, it really varies. And as I think Dania's sort of points on what makes a good net zero statement were really instructive. If I can speak sort of openly, I canvassed a few of my other colleagues on the buy side, and do we really see meaning in net zero statements, which are really, flavor of the month this year by all the majors. And in fact, I think most mining companies are coming out with some kind of statement. And I don't want to discourage that, because I think it's fantastic that people are setting aspirational targets. The reality, however, is actually they do need to be backed up by some kind of substance, by science-based targets. And I think, for example, BHP came out with a proposal that included scope 1, 2, and 3, but the detail around the scope 3 was that there was some quite big exclusions. And there was a perspective from Glass Lewis, at least, that this wasn't really enough to do it. So commendable that people are setting such ambitious targets for scope 1, 2, and 3. I'm not sure that investors are yet sort of baking too much into those, because, as you say, Dania, they quite often don't come with a very detailed map of how the company's going to get there, and they are more a PR document at this stage than a business model. But I think it's great that people are doing it. The thing is also, if I could speak openly, the CEOs who are announcing these strategies are in all likelihood not the CEOs that are going to be around in either perhaps 2030 or 2040 or 2050 to see these through. And one of the things that I think would be really meaningful is if people start putting accountability on these targets. So it's not just, an ambition, but it becomes linked to executive compensation or some other metric that people can see that is really going to incentivize the company to not just sort of talk the talk, but walk the walk at the same time. But again, I don't want to discourage people from making statements on scope 1, 2, and 3 emissions, because it's incredibly important. And I think if we're missing scope 3, we're really doing the whole industry a disservice. It's a challenge, but it's, there's certainly some excellent consulting firms out there that can help you understand how to track your scope 3 emissions. So you shouldn't be discouraged by doing so. And the other thing that we like to do as an investor is really be quite engaged and constructive and try and help people along their ESG disclosure journey and help them set these kind of climate-based targets. So there's just a lot of work to do. And unfortunately, as you said on the data point, there's not a lot of consistency. And it's hard to compare, one company's net zero plan with another at the moment because there's no.
Yeah, exactly. I mean, we've got multiple full-time analysts whose full-time job is dedicated to reading through these net zero announcements and deciphering, okay, what do they actually mean by this sentence? And does that make them actually comparable to this peer? It's a puzzle.
It's really difficult.
Mm. So maybe I'll turn to Dana, to yourself and to Jamie to ask, what are the tools that the companies or indeed the investment firms can turn to sort of get this huge amounts of data collated and to show that they are really doing meaningful, actions towards whether it's net zero or other ESG metrics for that matter.
I have a great answer for this question. It's a bit of a self-promotion, but Bloomberg and BNEF specifically is working to quantify transition risk for a number of companies. So we just put out transition risk scores for metals and mining, where we go out and collect various data sets for a universe of companies so that we can start to calculate, who's exposed to risk, who's exposed to upside versus downside, et cetera. People, that data is becoming more and more available because of a reaction to, talking to people like Kate or others who are saying, I really want to work more of this transition and climate risk into my valuation processes. But the fact of the matter is, all of this is a puzzle to work through, and it's very difficult to get standardized data. So this is something that we are pushing towards.
Yeah, and standardization is a moving target to some degree at the moment, if I'm not mistaken.
Yeah, I think it's one of the things that I'm looking forward to. The coming out of COP26 is apparently the IFRS Foundation is going to give us some more guidance on what this integrated financial and non-financial reporting might look like. I think we're still realistically about at least 1 or 2 years away from that, but there is this movement to make ESG disclosure mandatory alongside financial disclosure, and I think that would be the holy grail for an investor who just needs to read one report and can actually see the data, alongside the financial risks. It can also understand things like climate risks and any other ESG exposures that the company has, but it's not something that's going to happen overnight, that's for sure.
Yeah, the landscape remains fragmented somewhat, I guess, for an investor not knowing exactly where to turn.
Well, Adam, probably self-promotion. I'm sure none of your viewers have ever expected me to do self-promotion. So, but maybe I could have a go on this occasion. So, I mean, I think the key point which both Kate and Dana has basically highlighted is the lack of standardization. And therefore, it's perhaps not surprising then that when two gentlemen from BlackRock and Orion came to me last year and said, you've got to use your platform to basically come up with a solution for ESG disclosure, that was the heart of basically what we were trying to do. So, on the back of quite a lot of analysis, research, engagement, testing, we basically came up with a means to a set of right-sized frameworks which were future-looking, and that in itself, the future-looking point addresses much of the greenwash that is going on at the moment. Because if you can ask a management team, where are you now and where do you want to be within whatever time period you set that specific question relating to ESG, then you can then reassess in a year's time whether or not they've effectively, or 2 years' time, whatever it is, have they done that? And there's an opportunity for them to challenge that and actually go for it and go forward with it, just in the same way as forecasts or budgets or whatever it happens to be. So if you can, so we set out these 3 frameworks which are aligned to the global standards, and we worked with Satala to effectively do that and mapped, I think it was 25, 26 different standards, the ones you would all expect, which were both generic and also mining specific. And effectively allowed, well, first of all, addressed efficiency, because that in itself is frankly a joke. I mean, not just related to the mining industry, but all industries. But I mean, why, and I don't mean to pick at private equity groups, but why there are, 20 different questionnaires sent out to the company to ask the same question whenever a company is going to do a significant financing does not help the financial group, it doesn't help the mining group, and ultimately it doesn't help really anybody. So if we can try and address that and allow everybody to get that quality data, which can then be assessed, which then dramatically improves the efficiency, and then it helps, say, the private equities then add the cream on the top to identify areas of deficiency or whatever. That just improves efficiency overnight. So hopefully that is one major benefit. But then effectively to allow that to then be put into a robust and scoring methodology, which allows therefore that to be publicized and for companies then to be transparent in their process and ultimately allow comparability, allow credible tracking, which ultimately then moves to encouraging confidence and bringing new pools of capital to bear. So hopefully, I mean, this is the great goal, isn't it? To win the hearts and minds of society, which wins the hearts and minds of finance, which ultimately goes on to reduce cost of capital and hopefully make this industry allow it to kind of grow, its productivity and grow its increase its recruitment of younger people and bring basically more confidence to the sector as a whole. That's got to be the goal, and certainly that's our desire and mission.
Mm.
So Jamie, if I can just jump in, and not to defend the entire private equity industry, because I'm not sure that's my job. But there was a recent announcement that actually Adam and I were talking about the other day, that there's an ESG data convergence project going on with some of the largest global GPs and LPs are trying to agree on 6 standardized metrics, so that at least those GPs and LPs will be not sending different questionnaires. And although it's only 6 criteria and it's only scope 1 and 2, it's not scope 3. I think that's a step in the right direction for private capital, because as you say, it has been very, very difficult to for companies to respond to our requests and for for private equity groups to get the data that they rely upon. And so hopefully that's a step in the right direction.
Is that specific to mining, or is that industry agnostic?
It's industry agnostic as far as I'm aware. I'll send you the link. It's really interesting. So I think that shows that, there's a lot of cooperation in the space, and that's also very encouraging. People see the value in having a standardized set of data, and it's, although everyone's going to have their proprietary process and their own, assessment and valuation process, I think there is a need for standardization in the private equity industry as well. So
I certainly didn't mean to pick on the private equity guys. I'm just trying to improve your own efficiencies. But even if you're a fund manager or you're a debt provider, talking to a number of the different commercial banks, they're desperate to get these smaller companies who are coming to them, typically going IFC or Equator, to get up to speed quicker, to reduce that timeline before that. And obviously, if ESG is a godsend for them, because it addresses it effectively is for all companies. Doesn't matter just because you're getting to a development stage in mining. All companies are going to have to do this, so that if they can get up to a shall we say, a bar, and therefore they can then go through the Equator principles with that commercial bank, that improves the efficiency for them. That's just one of the kind of benefits, I suppose, of trying to create a standardized structure, which we've all been trying to fight over or dwell over the last few years. So
excellent. Let's move on to some insights on how the companies might have been performing. We've sort of touched on this a little bit, but how are the companies realigning their assets and portfolios for success in this net zero? We've talked about meaningful commitments. We've talked about measuring those or ways within which you can create milestones in order to get to the end goal. But how actually have they been doing it? And Daniel, could I turn to you just to talk about some of your coverage and research that you do on mostly the major mining tier?
Yeah, one of the data sets that we worked into the overall transition scores, I think is really interesting, is M&A data. So we wanted to get a sense of how companies were moving their portfolio to reduce demand risk, basically. And it's interesting because I think a lot of people started tracking divestment trends years ago, right? Who's announced coal divestment, who's announced fossil fuel divestment. But switching to the opportunity side, we can start to track investment trends too. So that's what we did. We downloaded the latest several years of M&A data for each of the companies that we were scoring. And we looked at, okay, well, which assets are you buying? Which assets are you selling? Are you selling assets that, analysts are projecting demand decline? Are you buying into lithium mines or recycling plants, I guess? Are you buying into assets where we can see a very real uptick in demand? And that was really interesting. And that really separated out the field. So you could see very clearly Rio Tinto did really well on that metric because they sold out of coal several years ago. They made several big investments, most recently into a lithium mine. And then on the other hand, you have companies like Glencore, so that they were on opposite ends of the spectrum almost, because Glencore, due to its coal strategy, is still actively out there buying coal assets. So that was one way that we assessed companies, and that was really interesting. It resulted in really interesting outcomes for a lot of the larger players. And we're also tracking not just portfolio pivots, but bigger steps, so expansions or new launches, or moving into completely new revenue streams. So FMG was a really good and interesting example of this, with their launch of Fortescue Future Industries, focused on, I think, green hydrogen production. So that's them saying up front, I want to be active and a part of this hydrogen economy that I'm seeing. So expanding into those nascent technologies, investing into those nascent technologies like hydrogen, CCUS. Alcoa is investing into inert anodes, which is a major way to get to decarbonized aluminum. So we're also measuring, investment into those early stage decarbonization technologies. But there's just a lot of things. There's a lot of things to track. There's just a lot of also data cleansing and data formatting and standardizing, of course, to get to a point where you can compare across companies.
Yeah. But Adam, what I find interesting about this specific debate is, the investing into a lithium mine or a rare earth mine in itself is not a sustainable decision. I mean, it's a matter of how are you going to operate that? How are you going to manage your whole operation on that? And equally, disposing of a mine doesn't mean to say that suddenly the world's all that much better, because obviously it depends on who it's being sold on to. And private equity gets a bad name, which I think is very unreasonable and unfair for that, because a lot of private equity groups, certainly the ones I talk to, and Kate, I'm sure, with Parla, operate mines in a sustainable and continuing to improve practices on that basis. So, but it's not a matter of just the investment or the divestment. It's effectively what that operation is. And really what we need to do is to encourage managements of existing assets to effectively incorporate a more sustainable way about going through that business. And that ultimately is what's going to change. And there's no reason why the cost of capital, in my mind, if one can do that and can credibly prove that, the cost of capital cannot come down and management get encouraged to further and enhance that journey. To me, that's what I think the heart of all of this is about.
So that stakeholder engagement piece and really improving that dialogue is certainly needs some enhancement across the board. Interesting. Is the conversation difficult, or is it embraced by CEOs? Kate, could I ask you, maybe perhaps with new companies that you look at. You mentioned that a lot are doing Scope 1 and 2. You know, there's recognition there, but is the industry perhaps split between those that willingly embrace this conversation and others who perhaps don't?
Heaven forbid you suggest that the mining industry is full of dinosaurs, Adam. You know, thankfully, I actually do think the naysayers are now few and far between, and I think more and more people recognise that this is no longer really a debate on you know, if and when. It's just how. And you know, I think there's a very broad range of sophistication and knowledge, and some people are further along the journey than others. But I do think generally as an industry, it has been taken up and people are genuinely interested in improving sustainability, because as Jamie points out, I mean, that's, to be honest, you're going to be unfinanceable at a certain point if you're not on this journey at some point. So thankfully, I do think, you know, with different levels of success and sophistication, I think almost all companies we deal with now are aware of the conversation and want to be part of the conversation. But, you know, as Jamie rightly points out, some of these conversations are quite difficult because, you know, for example, I talk to people who say, well, I've got this great proposal for carbon reduction, but it's actually uneconomic because my mine life, you know, runs out before then. So it's, you know, it has to be nuanced and sophisticated, and it has to be an actual business model that works. It can't just be, you know, capital allocation for the sake of it or jumping on a bandwagon. You know, the cost of the renewable energy in country need to be lower than the cost of the other energy, because otherwise, you know, it doesn't make economic sense for a company to adopt them. But, you know, I think the cost of renewable energy are obviously coming down so quickly that at some point that conversation will be over. But there's still a question about electrification of equipment. When will that be ready? When will it be safe? When will it be commercialized? And those are the kind of practical questions that I think CEOs are quite often interested in. You know, very on board with the concept, but can you help me turn this into an actual, you know, actionable business plan? Because, you know, thankfully, I think people understand that you can market all you want and say that you want to do, you know, the right thing, but actually investors are also going to care about whether or not you have a sustainable business model that generates returns. And similarly, the countries that you operate in are going to want to know that you will be a responsible owner, to Jamie's point. So it's a little bit more nuanced in terms of a conversation.
Yep.
Can I just say, tagging on to that point, I think this is particularly challenging, again, for metals and mining, because the path to decarbonization is so different depending on what subsector you're active in. So getting a copper mining company to net zero requires fundamentally different technologies and processes than getting a steel maker to net zero. And this is particularly challenging if you're a diversified company that's active across several segments or active across several materials. And that's just kind of adding to the complexity of all of this.
Yeah, absolutely. Okay, so in conclusion then, you know, how will ESG affect cost of capital? It already is for mining companies, surely. And it's a case of, you know, get the ESG right. And as long as your business model is good as well, then you're going to open up new pools of capital. Any final comments on that? Jamie?
I mean, well, it goes without saying from my point of view, because of what I've already said. I mean, I think we've already started to see this already start to take place, but we're at the early emergence of it. I mean, look, in 2 or 3, look, the regulators have already spoken. ESG as part of an investor's decision, any respectable investor or any institutional investor, it's going to be standard. So you're not going to step out whether or not everybody's going to have to do it. The question not is what are you doing about it once you're disclosing, and the impact you are making, which can be validated, can be continually monitored, and therefore to encourage, not just to encourage, but to prove that what you're doing is effectively real. And if the evidence to date proves out continue to be the case, that those companies which are continually active in doing that have a lower idiosyncratic risk within their business, then the cost of capital is going to change positively towards them. And so it should, because that's the way it's always been in finance, where you have lower risk. That's effectively, that's where the maths works. So, but it goes beyond that, because it's not just investors. I've got initiatives going on with the insurance industry, and they're desperate. They're behind the curve, or they are coming from behind the curve and actually rapidly catching back up. And they are desperate to get on board ESG into their pricing and capacity of risk discussions. But they can't use the existing stuff at the moment because it's not consistent or in their own words, credible. It came out in the Mirror conference last week. So they need nuanced information which is consistent and reliable for them to be able to act on an ongoing basis. The green bond situation, there's $500 billion worth of green bonds, and the mining industry has tapped in less than $4 billion worth. It's frozen out of the market. If we can start to access that, that will change the cost of capital for those companies that can access it. So the evidence is there. We just now need to be able to give the means to allow those doors to open for it to happen. Whether it's through private equity, whether it's through banks, whether or not it's through fund managers, or even kind of private clients, millennials getting involved in mining where they've frankly never been. Let's try and change that.
Certainly. Very good. So unless anyone else has anything further perhaps to add? No? Well, that's it. Thank you very much for a fascinating discussion. ESG clearly is changing valuations in the mining sector. And there's plenty of opportunity, as we've heard from this discussion, in amongst all the fragmentation as well. So we look forward to continuing this debate as we move into next year. So thank you very much, everyone, for joining the panel.
Thanks, Adam.
Thank you.
Thank you.